Okay, ladies and gentlemen, it's Richard Calhoun with Creekside Realty. I can be reached through Gmail, creeksiderealty@gmail.com. What I'm planning on doing today is highlighting what's happening in the 22 micro market areas in Santa Clara County. And on your screen is the different geographical areas in San Mateo and Santa Clara County, and it's color coded. And I have different metrics to measure what the market's doing. The most important one, in my opinion, is days of unsold inventory. And red is for a red hot marketplace or a seller's marketplace. The yellow is sort of for a balanced marketplace. And then the blue is representing ice cold and a buyer's marketplace. The reason days of unsold inventory is the most important is it's sort of a leading indicator, or at least the first indication of where the market is going. And this is based on the sales in the past 5 weeks. And so at this point, we have almost 3 weeks post coronavirus shelter in place, because most of the activity from the weekend of around April the 14th or March the 14th would have been accepted during the week of March the 16th. But shelter in place was announced then, and so any buyers that were having cold feet would have had an opportunity to pull out and reduce the number of sales, therefore increasing the DUI. DUI is a great objective way of measuring on how fast the market's moving, how quickly we would sell everything that's currently on the marketplace. And you can see the vast majority of the areas are red in color, which means it is a hot marketplace. There are a couple notable exceptions in San Mateo County, which is a little unusual because San Mateo County typically leads the Bay Area. And right now it tends to be lagging behind and has been for a little bit of time, or at least it's slower. And so you can see you have a couple blue areas down there, and they're expensive areas. And that's partly affordability, partly the high-tech IPOs, those kinds of things. Yellow areas are sort of a balanced marketplace, and in San Mateo County, you can see that's mostly the county. But believe it or not, overall, that's enough of the county that the county overall is sort of slowing down and sort of in a balanced marketplace. Now, it's right on the verge of still being a seller's marketplace, but it's above the 40, and therefore it gets the yellow designation. Santa Clara County is doing much better. The only areas there that are slow are, again, the expensive areas right along the San Mateo-Santa Clara County border. And that's a little unusual because those are normally the fastest areas. And right now, they're actually the slowest areas. So that gives you sort of a recap based on days of unsold inventory. Moving on to the next two columns, they both require sale price. One is the frequency of overbidding, which is how often a buyer is going to pay more than the asking price. And the second or the third column is the magnitude of how much they're willing to overpay. And again, you can see that is a little hotter marketplace. The areas like in San Mateo County, you can see the yellows have disappeared. In part, that's because it uses sale price, and the sale price is delayed by 4 weeks from market conditions. So most of the closings now are pre-shelter in place. So that gives you an overview in the county. I'm hoping to upgrade this to a map geographically so you can visualize it easily, but it's laid out by the two counties and then cities, and within the city of San Jose, I have it broken down. So the San Jose areas are sub-alphabetized as if they were all San Jose hyphen. So I think that's pretty straightforward. And we will move on to looking at each individual thing. And as I was saying, DUI is the most important aspect. It's going up at the end, which is not a very good indication, unfortunately. But it's also not going up very rapidly. Here's the 40 threshold. So the bulk of these areas, although they've come up from 20, they're now at 25. They've come up from 30, they're now approaching 40, things of that nature. So not alarming, and that's also to be understood, because what's happened right now is we have the new listings that have come on for this week, and because we can now show vacant properties. So they're coming on, but we haven't had the sales activity. So this will increase, it will reach a new equilibrium that I don't think is going to be much higher than we currently are. So that's where we are for the most important indicator, days of unsold inventory. Now we're moving over to the frequency of overbidding. How often do buyers have to overpay? And you can see right now the red line is Santa Clara County single family homes. And you can see we're basically right up here at about 72%, which is pretty amazing when you think about it. That means 7 out of 10 sellers are getting more than they're asking, and 7 out of 10 buyers are offering more than the seller is asking. The trend has clearly been up. The only word of caution is because this is closings, it requires sale price, therefore a 4-week delay. So these escrows that have been closing that reflect this are all before shelter in place impacts the data. Moving on to the next one, which is closely related, is the magnitude of overbidding. This sort of gives you an idea of how dramatically the buyers feel the pressure. Are they willing to pay 5% over, 10% over, 20% over? And again, you can see the trend has been pretty much up. You might even say it's been flat for the last week. I would suspect now that we're in shelter in place, it will go down a little bit. But if you look at Santa Clara County overall, and if you're getting 5% more than your asking price, you can't complain. I would also just point out, you have a series of dives here. And when you have that across most of the market areas, what happened is my data got out of sync, and I haven't had an opportunity to go back and correct it and find out what the real data points are. And so when you see that, just ignore it and jump on the green line to the green line, the red line to the red line, and just ignore the little down on the red line. So you can see that each data point is there. It's real data. Here's one that's sort of by itself, which is a little more unusual. And this is my last data point. So if there's any errors, the condos in San Mateo County are the most likely to get infected. So something got out of line right there at the end of my processing, and it got an up spike there for one day. But the underlying data for that same date are all good. Here you can see there's quite a bit more. And so based on that, I can go back and figure out which micro market got blown up, find out why it's out of sync, line up the sync, and redo my data. And that is all on the project list to do. Moving on from the key things, we're going to jump into inventory. And the reason we're doing inventory next is inventory, supply demand. You would think either one's equal. Historically, when you look at the data, the inventory has a greater indication of what the market's doing. As inventory goes up, the market tends to slow down. As inventory goes down, the market tends to speed up. But there's a huge annual cycle to this where the minimum inventory is typically right around January the 19th. And you can see this year it happened a little bit earlier. It was January the 6th. And then it basically started climbing right after that. And typically the peak of the market is on right around the middle of July. I actually picked July 19th because it seems to be that date more often than not. And you can see we are going up. Now here it's going to be shelter in place coming out with the announcement, and boom, it comes sliding down. So we dropped, we have lost sales, no question about it. But you've gone from 200 to 684. Is that a huge drop? Significant, but it's not the end of the world. You're losing somewhere around 120, 150 transactions. So the volume of transactions is down. And no question about it, when you can't show a house, it's difficult to sell it. I maintain that very few people are going to buy houses virtually. We now are able to, starting this weekend, able to show vacant houses with some restrictions, but at least it lets you get in there. You might say, well, what's the big deal? Well, 50% of the homes we typically are selling have been vacant because of staging and other things for quite some period of time. And if the only condition is to sell the houses for it to be vacant, I think you're going to have more sellers moving out. So we may not have the recreational or the higher character sellers, but we will have the serious sellers that need to move on with their lives, and those will be on the market, and I do expect them to be selling. Moving on from inventory, this graph is actually a little bit surprising to me. It's the median days on market, and you would expect that we would be slowing down. Shelter in place is back here on the 16th, and basically we've been flat, and surprisingly, if you look at these little trends at the end, they've actually been going down. And for the real estate agents, you might think, that's because the MLS has frozen days on the marketplace, so a lot of more homes are selling at zero. Well, I do my own compilations, and I actually calculate days on market by sale date minus list date, and I am not freezing it because I wanted to be able to see what happened to this number, and I'd rather not process the data and then just make the mental note. And I was actually expecting this number to go up. But what it say to me is the properties that have been coming on the market are actually in higher demand now than they were before. Now, granted, those lines are pretty horizontal. And if you think about it, it's pretty hard to sell 50% of your homes faster than every 8 days. Well, we've pulled it off and we're now selling 50% of our homes in 7 days in Santa Clara County, single family homes. And that is the record fastest we've ever been. 8 had been the fastest record. So going down a day is huge. And what we don't know is if we're at 7.49 and we had been at 7.51 and there's almost no change because it basically rounds to the nearest real data point versus averaging. If I was really good, I'd probably be sitting there and doing an average on data like this that does incremental when it's this low. But typically, anytime you have a data point that can go to infinity, such as days on the marketplace and can't go below 0, median is typically a much better measure of it. But when your 1 day steps are huge, that becomes a little irrelevant. We're now going to look at number of offers being accepted. And here you can see, and this is the impact dramatically right here. This is going to be the weekend just before shelter in place. So shelter in place came up and we immediately started having dropped down. So you could, if you wanted to project the number of sales that we're missing, you project this line up straight up like this and then come down. And let's just play that game for a second here. It will only take a second. We can change the axis here. I don't know how high I have to go. I think 1600 is going to be way overkill. Okay, so now if you draw a line up here, and it's going to be pretty sketchy, maybe you draw it like there, and that would be hard for me to believe because we typically, historically, don't sell that many. So let's even go to 1200. So you're going from 1200 and now you're down to 700. You've lost maybe 50% of your sale. If you did a straight line, you would be up there. Realistically, I guess we're right about at the peak. And even though the most number happened 5 days before Memorial Day, we're nowhere near, the rate of this climb slows down. So, if I was to guess, and I'll try to work on this for next week, maybe we've lost from 1,100 down to 650 homes. So, you're losing some number around 450 transactions, which is pretty significant. But there is still an activity out there. Moving on to the next data point is sale price, because everybody likes to know what the prices are doing. Basically, if you look at price, it's for the most part going up. There is one exception to that trend, and here, the red line again is Santa Clara County single family, and I use that sort of as my benchmark because that was where the most properties are and makes up a bulk of the marketplace. The notable exception is up on this line, which is your expensive areas in San Mateo County, where you can see it went up and it actually came back down again. So why you had this huge balloon here, other than more expensive homes sold, is pretty hard to understand. When you're talking about high-end properties like that, it doesn't take many homes above to bring up the median. So if you really looked at the graph probably would have gone something like this, never shot up there and gone flat through this section here. In these, you have not as much fluctuation in price, and the lines are much more well-behaved. Now we're moving on to the median sale price, which is what everybody follows. These lines have a lot more stability to them because you're talking about what's happening in the middle of the marketplace, which doesn't get those big swings. And again, the trend is up to the right, which is good. You can see the red line for Santa Clara County single family homes there. You might argue that it's leveled off through here, and it looks like it has, and I'd probably pick up a number. There's 1.4 million. It's actually gone down because I think we're at 1.3. Oh, no, we're at 1.430. So that is actually still 23,000 higher. So let's actually do this. Let's pick up the 16th and let's even go to the 17th. There's shelter in place, 1.4 million plus 7,000. And now you're at 1430. So the median sale price has actually gone up by $23,000 during shelter in place, but this is not reflective of the marketplace since shelter in place because your typical duration of escrows is about 4 weeks, 28 days. So even now on April the 4th, we're talking about what happened before shelter in place. And the last price curve that we have going on is the 10 percentile pricing. And the 10 percentile pricing shows what's happening to the lower end. And again, basically the trend is up and to the right with no dramatic shift and changes. duration of escrow that I've talked about. And what's interesting in this graph is most of the lines are pretty horizontal. They jump up and down because, again, they're increments of full days, which is why it's not a smooth transition. But if you pick up the Santa Clara County single-family homes right there, you can see here at 29 days, which is pretty good. And then you can see here it's jumping up to 30 days. And if you come back, you can see it was down here at 27 days. So we've increased, and that is a direct result of shelter in place. And now you might say, well, wait a minute, how can that be a direct reflection of shelter in place when the offers were negotiated beforehand? Well, what's happening is people are in there with their take close of escrows 28 days, 25 days, they could have done before shelter in place. Now with shelter in place, they're not able to achieve those fast turnaround times, and they've gotten delayed. And the delays can be pretty minor. I had a personal transaction where the buyers did not use the lender did not put the buyer's middle name on the loan documents, but yet it was in the trust. And so they had to re-sign, and that basically is delaying us from closing last Wednesday to Monday or Tuesday of this coming week, just because the turnaround times were longer because of the pipeline and illnesses and people not able to pick up the phone and talk directly because, number of calls and communication. So we're getting, it won't be a week delay, but it'll probably be a 5-day delay simply because the lender did not initially put the buyer's middle name in a loan document. So that can be pretty dramatic and would cause us to increase, but you can see that several of the areas are going up, and that, in my opinion, at this point in time, is directly related to shelter in place. And the one graph that got out of order that I've been jumping over is closings. Here's the number of closings, and it's coming way down, and this is because of the lag time. And if you look at it, this puts you back right at the holiday time, and then you've been basically coming up dramatically. But that's a yearly cycle, and you might be able to argue that it's coming down. One data point, I wouldn't really say that, but then if you come down to all of 22 micro market areas, they all tend to be looking like they're going down. So the number of closings are going down, and that's because what we're already starting to miss is the 3-week closes, the 1-week closes. Those have dropped post shelter in place, and so now that's showing up in overall number of data. So that's what's happening into the micro market areas. One graph that what I'm looking for right now is my CFT data. This is data I normally have historically not followed, but it's worthwhile doing just to see if there's any huge trends. And there's two different groups of data. There's the data at the top, and the data at the top is for the entire MLS, which includes a couple Central Valley counties. It includes all types of properties, and that numbers are much bigger. The second group of numbers, just because Santa Clara County single family homes is my benchmark, is what I did here. And if you look at the number of transactions falling through, you can see they're all single digit. If we scroll back here to where shelter in place was basically announced, you can see that some of the transactions falling through were a larger number, 5, 7, and then a week later we had 5s and 7s, but for the most part were 1, 3s. What's that mean? Well, the MLS using this top bar looked at the data, and they came out with an analysis that said that TFTs is up 45% in 2020 versus 2019. And I said, wow, I'm surprised. So I looked at their data, and it sort of matched with what I got using their data set. So I used that same data set for Santa Clara County and found out that it dropped to 30%. And that's a 30% increase, not 30%. The 30% increase was less in Santa Clara County, I think in part because of the buy in Santa Clara County. You have 2 working people, probably in the high tech field, that are continuing to work afterwards and are continuing to get your paycheck. So the impact hasn't been as much. Then when you put it in real terms, what does that really mean? Well, I went back to a Monday before shelter in place and after Super Bowl. And if I think about it, I can figure out what Monday it was. Super Bowl was February the 2nd, I believe. So February 3rd, I went February the 10th. And I looked at the transaction fail rate of that group of pending transactions at that point in time. And it was 4.5%, which would indicate we were in a strong marketplace. because 4.5% is lower than you would expect it. And when you are in a strong marketplace, TFTs tend to be low because even if the buyer stumbles into an issue and can't resolve it, they may continue with the house simply because they know if they go back on the open market, it's going to be difficult and they will pay a higher price. So they might as well eat whatever they need to eat on the house they're in on, and just keep the transaction together. And in the meltdowns after the 2007 mortgage meltdowns, the TFT ratio was over 50%. I actually got 65% once when I was looking at it. And again, I was looking at it on an individual basis because it was such an important factor. And so anyway, 4.5% is clearly on the low side. I was a little surprised it was that low. I would have guessed, somewhere between 5 and 10%. And then I looked at shelter in place on the Tuesday, the Monday, the transactions that were pending on Monday when shelter in place was announced. I looked at those over time, and the TFT ratio went up to 6.5%. So then what does that mean? Well, if you closed 1,000 transactions, or you started 1,000 transactions in a month, you've gone up 15 additional transactions. Essentially what I'm trying to say is I think it's a drop in the bucket and it isn't a big issue. And I think that sort of wraps up the real estate end of things. And I was going to show one more graph real quick that I didn't pull up, and data on the coronavirus, which is what we're really all focused on right now, and justifiably so, and looking at what the data shows. Here it pops up. You can see when coronavirus started, we were actually doubling every 3 days. And this is the number of cases published by the Santa Clara County Public Health Department. And then we went from every 3 days down to every 4 days on March the 10th. And, our Governor Newsom, came out with his model of, 56% of the Californians would be infected in 8 weeks if we doubled every 4 days. But subsequent to that, here starting on the 18th, which was basically coincidentally just after shelter in place was announced, and before shelter in place would have any impact, the natural course of the disease slowed from every 4 days, from every 3, then every 4, and then every 5 days. And now when you could argue that shelter in place is finally having an impact starting on the 26th of this month, we're now doubling every 8 days. And, maybe people say, you're a real estate agent, what do you know about coronavirus? I say, just go to the Mercury News headlines online starting late yesterday and this morning, and they talked about how in Santa Clara County, cases of virus had gone up 90% in 7 days. So if you've gone up 90% in 7 days, you're doubling in just about 8 days, which is what my data here is. And if you look at it, you can see the curve is getting flatter and flatter because as you go more and more horizontal, the days are longer. So we have actually started to flatten the curve. No, the curve is not flat. Yes, the number of cases is still going to go up, and it is going to go up more. If you want to take a rough number, depending on how long you say the, people are hospitalized and how long they're impacting, what you can start saying is, the number's going to start leveling off probably somewhere around 2,000-3,000 cases. And that's total cases, not cases that are going, because one of the things we have to remember by now, the people that got the disease way back here are starting to recover and are no longer needing hospitalization. So anyway, we're definitely making progress in leveling off the curve, and that's not getting out there in the media. I think we're getting back to real estate to some degree now that we can show vacant properties. And I would normally, at this point, open it up to questions, but I lost my audience because for some reason I didn't get it recorded the first time. So this was a reenactment. And we'll be back next week. And because I had to reenact it, I'm not going to reenact the monthly data. I will save that for the second Saturday of the month, and I will be doing that going forward. So typically on a Saturday when you tune in, you'll get a fast recap followed by questions. On the second Saturday, you'll get a fast recap, questions, and then moving on to the monthly data. And the monthly data is nice because you can also compare over the last 20 years. And since I have no one to ask me questions, I'm going to sign off, and I'll see you next week. The URL, by the way, for people wanting to jump on, it's a little bit long, but pretty simple. It's tinyurl.com/RE for real estate, RE market graphs, plural. So tinyurl.com/RE market graphs, and then the date. And the format of the date would be the year 2020, the month 04, and next Saturday is 11. And that will get you to the URL. And after we get used to this, that prevents me from having to sending out emails all the time. It also looks like Zoom may have updated their software after my session, and we may have to do a password going forward to prevent the hijacking that's been happening. That looks like it may have taken effect because I can't unpassword protect. And if that happens, I am going to have to send out an email. So we will roll with the punches and hope to see you next week. Bye for now.